Hello and welcome to the week ahead. My name's Joshua Mahony, Chief Market Analyst at Scope Markets. Let's look at some of the key events for the week starting Monday the 27th of May. Bearing in mind, we have got a relatively slow start for many with the UK and the US both observing bank holidays. But nonetheless, there's plenty to sink our teeth into, in particular with the theme around inflation. We're coming into this week with a big focus on the potential reinflation in Europe and in particular over in the US, the economic strength that we have been seeing most notably at the back end of the week just gone with the strong PMI numbers and the decline that we've seen in terms of those unemployment claims. At the sort of early part of the month, we had seen a lot of optimism. We'd seen the Federal Reserve coming out with what some had deemed to be a dovish meeting, but ultimately people were really focusing on this idea that they said their next move is unlikely to be a rate hike. We then saw weakness in terms of the payrolls number, a higher unemployment rate number, retail sales at 0%, an upside move in terms of unemployment claims. And so we saw some optimism within markets, as we said, the back end of earnings season. Now earnings season, by and large, is finished. We've only got maybe 3 or 4% left of the S&P 500 to report. And so the focus is really going to be on the economics. And the thing is that when we've seen the economic data coming out recently, it started to look more positive. And that comes at the same time as we saw the FOMC minutes coming out, where they essentially had a number of members saying that perhaps financial conditions weren't tight enough. They were too easy, which points towards a possibility of additional rate hikes in the future. Not necessarily great for market sentiment. We did see some significant volatility in equity markets off the back of that. So that's the backdrop of what we're looking at for markets at the moment. And when we look ahead to what's coming in this week, we've got plenty to influence thinking on that front. So let's first and foremost get into the data from a big picture perspective. These are the sort of top level events that we're looking at for the week. You're talking about, in particular, the big first part of the week, a focus on Germany, the IFO business climate number, the GfK consumer confidence number, and then the inflation reading coming out of Germany. On Thursday, we have the revision to the GDP number coming out of the US. And then on Friday, it really gets particularly busy with the inflation metric coming out of the Eurozone. We've got PMI number coming out of China. We've got GDP from Canada and that all-important core PCE inflation metric coming out of the US. And that's exactly where we will start with the US. Here's a deeper dive on some of the main events over the course of the week. Tuesday, things really kick off. Like I said, Monday, bank holiday over in the US and Memorial Day. We've got consumer confidence, Dallas Fed manufacturing index, that revision to the GDP number, jobless claims, trade balance data, or essentially trade data, home sales. But really, Friday is likely to be the big one with that core PCE number. Particularly notable. You know, I've mentioned for many months now that if we're going to see the US return back down to target in the near future in terms of inflation, it's the core PCE that's going to manage to do it, not the others, because the likes of CPI, the likes of core CPI, both trending in a direction that wouldn't fill me with confidence that we'll move back down to 2% anytime soon. But there's question marks around that core PCE metric as well. So here's a breakdown. You might recognize this of the core reading. So core CPI, core PCE. And bear in mind, the core PCE is the metric that is favored by the Fed. So certainly if they do get back down to target for that metric, it would give them enough to be able to say, hey, look, our favorite metric has hit target. Therefore, we're happy cutting interest rates. But where are we at the moment? Well, you can see at the top section, around about 2.8% at the moment. And if you look at the sort of section in the middle where we're looking at PCE, which would be the sort of orange, yellowy orange bars, you're looking to see exactly what's dropping out and you're looking to see what's happened recently. Well, firstly, what's dropping out? We're looking for the May figure. So you can see here, it's sort of somewhere in the middle. It's around this sort of 0.3 mark. It's roughly around the area that we've seen the past two figures, the February and the March readings. It's somewhere in between the two. So there's a good chance that we do see inflation from the core PCE perspective remaining relatively flat if we're going to continue on the monthly trajectory seen over the past couple of months. And then, like I said, if we cast our minds back to not just a year ago, but 10 months ago, 11 months ago, 9 months ago, you look at these readings, the June number, the July, the August, the October, November, December, all of those fall below the figures that we've seen in the past 3 months. So the trajectory for inflation has picked up in 2024. That it has been notable across not only the US, but also other countries around the world. And it's notable that it's happened on both the core figures, but also the likes of the headline numbers. So it's happening across the board. And we're seeing underlying inflation pressures build. And that really sets back expectations for the Federal Reserve or the ECB or the Bank of England to be cutting interest rates in the very near future. In terms of expectations, we'll go back to that prior slide, and you can see here core PCE on the monthly expected to come in at 0.2, which would be a welcome development if that happened. It would be a shift from where things are at the moment. So as we can see here, 0.317 was the last time around. So a figure closer to 0.2 would be a welcome development. But certainly if you look at, say, the 8-month annualized, which is me sort of trying to capture not only the near-term moves that we've been seeing, but essentially where would we stand in 4 months' time? Well, that's pointing towards a 2.88, and you can see that has been gaining ground. We were on target to hit that 2% metric by the turn of the year. It looked like by this point, 4 months later, fast forward 4 months, it looked like we were going to be at target. That has not happened. We're at 2.8 at the moment, and there's a good chance that we do tick higher over the coming months because whilst this May reading of 0.3 roughly that's going to drop out is relatively forgiving, the months in advance are going to be 0.2% and below. So we need to see something similar to be able to at least maintain the trajectory, let alone see significant moves back down towards target. And ultimately, beyond May, the only month where we're likely to see significant downside in terms of inflation, unless we see 0% or negative monthly core PCE, would be September. And then we have to wait all the way to the back end of the year for January. And then we see that big 0.5 reading drop out. So look, the expectations for a September rate cut, I don't necessarily know where they're founded on, what they're founded on. That's why we've started to see Federal Reserve members coming out and saying, well, we could actually raise rates next. Because you look at what's happened since the turn of the year, and we're not on a trajectory to target. We're on a trajectory back up once again. It's not like we're going to start seeing 7, 8, 9% like before. But I think there's a good chance that we do start to see, starting next month, inflation start to pick up once again. And it really is likely to hit home to many within the markets that have been hoping that we're on the cusp of a rate cut. This is the S&P 500. Let's just give you the full screen situation here. From a wider perspective, it looks great. It keeps going up, right? So this isn't necessarily something that actually I'll tell you what, let's get the Dow and I'll tell you why. So the Dow has underperformed the likes of the Nasdaq and the S&P 500. The reason being that we don't have Nvidia to save us on this one, right? You can see these sharp declines coming into the fore for this market. And Nvidia up 9% after earnings did manage to arrest those declines for the likes of the S&P 500 and the Nasdaq. We don't have that influence for the Dow, and that's why it's really underperforming. It really does highlight that this near-term intraday uptrend is over, and it points towards a possible retracement of this wider move and potential double top formation if we were to break down through 37611 support. But let's take it one step at a time. So what we're looking out for over the course of this week? Well, look, Monday, markets going to be closed or quiet. Then we have 3 days, and then we have the core PCE. So I think there's a good chance we see some jitters coming into play. I think that core PCE metric, if we do come in above that 0.2%, that could drive further downside. And if we're looking at the near-term price action for this market, we have been on a bearish trajectory over the near term. From that wider perspective, there's a strong chance that this pullback that we're seeing at the moment is ultimately a retracement before we head higher once again. But certainly, given the risk that is innate within markets at the moment that I see and I have seen for a while now, I think there's a good chance that we still see some selling pressure coming into play. The caveat here is you're going against the trend, right? Which is not necessarily something that I always advise to do. But ultimately, we're very clearly within a retracement phase now because we've broken down through that support level of 39371. And therefore, it's a question mark of how deep do we go? And I think really that's going to be determined by some of the data that comes out over the course of the week coming. Are we going to see strong economic data akin to that PMI number that sends this market lower? Are we going to see strong inflation data that, again, hammers home the idea that we're not necessarily going to see the Federal Reserve cut interest rates in September? We might not necessarily see them cut rates twice this year. Ultimately, the Federal Reserve are data dependent, and that data dependency means as you see strong economic data coming out and strong inflation data, you're likely to keep pushing those expectations further down the line, despite what people have said in the past, because the Federal Reserve had a dot plot that signaled 3 rate cuts at the end of the year. That fell by the wayside. People were expecting 7 earlier in the year. Things keep changing, and they're not necessarily changing for the better. So I do have a relatively bearish view of this market over the near term. And that core PCE metric, maybe it comes in low, right? Maybe it comes in at 0.1 and it starts making everyone feel great about themselves. But bear in mind that even if that was to happen, you could still look back at what's happened over the past 3 months and think, well, there's a good chance that we are going to see either flatlining or upward inflation pressures over the next 6 months, which is probably going to put people off the idea that we're going to see a rate cut anytime soon, given those base effects that come into play. Next, I wanted to bring up here we go, the data around Germany, the Eurozone, France to some extent, but ultimately this really has a big theme based around inflation, and that inflation data is all going to be coming out on Friday. So once again, big day on Friday. So Eurozone inflation on Friday. We've also got French inflation on Friday, but earlier in the week we have the German number. We also have Spanish inflation coming out. So essentially what we're looking for, of course, is a continuation of the downtrend for inflation. Makes everyone feel great. We're on the cusp of a rate cut. But what are we seeing? Well, this is really interesting, right? Look at what's happening on the German side of things, right? You've got 0.2 forecast on a month-on-month, but it's 2.5 forecast on the year-on-year. And some people might say, how could that be? We're seeing a decline in the monthly, but a move higher in terms of the year-on-year. It's because of those base effects that I talk about constantly. And ultimately, if you're seeing a downside move here, but a move towards the upside in terms of the annual figure, then clearly the figure that has been replaced or is being replaced from a year ago was lower than that to 0.2. And then if you look at the Eurozone figure, what we're expecting, a move towards the upside, 2.5 expected. Core expected to decline to 2.5. So a convergence between headline and core inflation with the month-on-month expected at 0.1. So again, relatively or very low expectations in terms of the monthly figures for both Eurozone, the German numbers here, and the French one, 0.2. But all three are expected to lead to a move towards the upside in terms of the inflation rate. So quite how markets are going to take it. In all honesty, people generally focus on the year-on-years. Maybe it's just me that geeks out on the month-on-months because I find them a lot more telling in terms of the near-term story and the current trajectory of inflation, whereas the year-on-years tell you probably more about base effects and what's dropping out from a year ago. But nonetheless, if you see upward trajectory in terms of inflation across the board over the course of the week, that doesn't necessarily make people feel great. And, you can see here in terms of the Eurozone figure, exactly what I'm talking about. So I was saying, even if you see a low number, 0.2, let's say, or I think 0.1 was what was expected for the Eurozone readings. So 0.1, yeah. Even if you see a 0.1, well, where were we last time around? Flat, 0.02. So anything other than a 0 reading is going to increase that year-on-year metric. So we're close to target, but it looks like perhaps we're going to bottom out here. And we're so close, but I think there's a good chance we start to turn upwards from here, because look at what's coming, right? It's 0.02. Then what's that going to be? 0.1. Then we've got a negative reading coming in for July. August is an okay number, but that, what's that going to be? That's maybe a decent number to drop out. And then we start to decline once again. November has a big negative reading that's being replaced. And ultimately, the big figures there to be replaced have just been set. We're talking about February, March, April of this year. That's where the big figures are. 0.6 on the last metric, and we had a higher figure, the one before that. So yeah, I think it's going to be a tough time to get to 2%, quite frankly. I think it's very unlikely we get to 2% before next year, because we need to start chopping away at the numbers that we've only just set for us to see a move back down to 2%. We've got the 11-month annualized figure here, 2.56 for this reading. So essentially, if we put a relatively average number, then we'll see a significant increase on where we were before. So, it's worthwhile noting that we're probably going to see an increase in inflation metrics across the board in the Eurozone, which isn't necessarily great in terms of market sentiment. You can see in terms of the core reading, we've also got a similar kind of trajectory in terms of relatively low inflation for much of the last year, but the figures that have really picked up in the last 3 months. And you can see, if I put a 6-month annualized figure, you can see this significant upturn over recent months. So whilst this core inflation reading is expected to decline further down to 2.5%, I think there's a good chance that soon enough that downward trajectory stutters and perhaps starts to turn upwards ahead of a return to 2%. So I don't think we're going to see either of them hit 2% for most of this year, quite frankly. So yeah, it's going to be a tough time. It's going to be a tough time. In terms of what impact this has on markets, well, let's bring up the euro against the Swissy. Bear in mind, the Swiss are the ones that have already cut interest rates, so they don't necessarily have as much of a problem when it comes to inflation. And so how's that play out? Well, weakness for the Swiss franc, and we can see here a very nice uptrend. So this is one that I've been highlighting. I think last week I was talking about the dollar Swissy. And so, yeah, it just continues to play out at the moment. We've got a very nice trend here. And so if we're talking about the potential concerns around inflation in the Eurozone, you just got to try and find what other markets they don't necessarily have those concerns. What markets are you going to be fearful around weakness for that currency? And for me, that's the likes of the Japanese yen and the Swiss franc. So we're seeing this sort of strengthening story coming into play here. It's notable. I could see if I can try and drag it up. I've got a chart around here somewhere for the. Here we go. Let me see if I can get this across. There you go. So this is a comparative for the 10-year yields, right? And so this is the trajectory over the course of the past month, essentially. And it's the EU 10-year that has gained the most, with the UK 10-year gaining beyond that. And that's why we're seeing such outperformance of late for the euro and for the pound, because we're starting to see people really start to price in fears around UK and Eurozone inflation being elevated. It wasn't long ago we were feeling very confident about the idea that we're going to see European central banks cut interest rates and that the US was in trouble. But recent months have seen data that points towards a similar kind of picture here in the UK, a similar picture in the US, in the Eurozone. And that's why we're seeing that relative move coming into the fore here with the likes of the EU 10-year, the UK 10-year, both gaining grounds. And that's why we're seeing particular strength for the euro and the pound. So you try and find the currency that you think is going to be strengthening the most, you try and pair it against the one that you think will be weakening the most, and you come up with a chart that looks like this, where you see very nice trends playing out and you continue to move in a single direction. That's the name of the game, in my opinion. So we've rallied up through 0.99156. We could see a pullback soon enough. It's very interesting to see how this has happened, right? So we see this sort of sharp pullback into a deep retracement, probably let's go, that's probably a 76.4. Yep, slap bang on a 76.4 fib. And then, consolidation from that support level, and then just bigger candles. And we're just really starting to reach an upward trajectory from here. So very nice upward trajectory coming into the fore here. I would expect to see this trend continue unless we see a break through the price swing low, which now that we've broken through this swing high, we'll be looking at this low here at 0.988 as that swing low. So unless that breaks, then the bullish trend is in play still. But at some point, markets don't move in a straight line. At some point, we're likely to see a pullback. And that could be an opportunity. It really depends on how people trade it, whether they wait for retracements, whether they wait and play the breakout, because we have just broken out. Different ways of playing this, but this is a really interesting one to be looking out for in a week that by and large looks like we're going to see bad news in the form of being told that inflation is moving higher across different regions in the Eurozone, and that we're basically not about to see a return to 2% for Eurozone inflation. And then finally, I wanted to talk about Australia. So Australia, it's an interesting one because not so long ago, we saw expectations for the RBA shift where essentially markets aren't expecting anything from the RBA this year, right? But we did see a shift where the outside chance wasn't for a rate cut. It was for a rate hike. It was more likely that we were going to see a rate hike this year than we were going to see a rate cut. That has actually shifted recently. So that's interesting. But I pulled this up because we've got retail sales coming out. But notably, we've got that monthly CPI reading expected to drop down to 3.3. So still way away from that 2% target, which is probably why people are thinking, you know, we're not going to see anything from the RBA anytime soon. They do have a housing crisis, and they do need to try and alleviate some of those pressures. But housing is part of the problem, right? It is the biggest determinant of inflation for Australia. And if we look in terms of the breakdown, you can see that red section here. It still makes up a very hefty contribution. If you look at sort of pre-COVID levels back in 2019, you know, it was much smaller than where we are at the moment. So housing costs remain elevated, as do other areas, quite frankly, but we need to see that continue to shrink as we move forward. This is, bear in mind, Australia is a funny one. We don't see month-on-month inflation metrics. Instead, we see monthly annual figures, and we also see quarterly numbers coming out. So this is a comparative of recent quarters, because last month we did see the Q1 figure coming out. And so where do we stand? Well, the last 3 quarters annualized would take us down to 3.13. So the trajectory is towards the downside, kind of, but I don't necessarily think that we're really heading in a direction that sees us or sees the Australians hit target anytime soon. So really, we have seen a continued downtrend in terms of that year-on-year figure, that annual figure. But I think, you know, if you're looking at underlying metrics, by and large, we're not necessarily on track, I wouldn't say, to hit that 2% target anytime soon. And soon enough, you know, that's likely to sort of taper off and start to flatline, probably in the high 2%. So a similar kind of problem probably going to come to fruition for Australia. But, you know, maybe people just focus this week, if we do see that decline as it's expected down to 3.3, maybe people are just thinking, you know, great, we're going to see a decline in terms of inflation, perhaps. Nonetheless, the story around Australia remains no rate cut this year. That's what markets are pricing, and therefore you have the potential for strength around the Australian dollar. We can see also here that we've got the manufacturing and non-manufacturing PMI numbers coming out of China, both expected to decline, but both expected to come into or remain in positive territory. So it's something to watch out for as well. The final chart I wanted to highlight is the Australian dollar against the Japanese yen. Let me again get my little head down here. And we have a chart that by and large is very bullish. Again, the name of the game is trying to find those weak spots and trying to hammer them, essentially. I mean, look, you know, this is the kind of chart you want to be trading, in my mind. The caveat, of course, intervention from the BOJ. You know, that is the big concern. And we're heading back up to, on this chart, it's 105. You know, different levels for different charts. But ultimately, these are the kind of areas where we did see intervention in the past. So that is a risk. It really does highlight the risks of holding positions over the weekend, but also holding positions and not having stop losses. Absolutely key. You need to be able to control your risk on these ones. But you're looking at a currency that, unless we see the BOJ coming out and pretty much saying that they're going to see some hefty interest rate hikes, which seems very unlikely, then you're looking at a chart that by and large is in a bullish trend. We're regaining ground once again. You know, what happens in the past when we see intervention from the BOJ? Well, first couple of times markets sort of believe the hype and start becoming fearful, but soon enough that level they were protecting gets blasted through, and then it goes quiet for a while, and maybe they protect a different level down the line. Are they going to protect this level once again? Perhaps, but let's keep an eye out for this one. It's definitely a very interesting market to be watching out for if we're looking for that Australian data to be coming out. A break through that 104.244 ends this sort of retracement phase. You know, are we going to see further downside over the near term? Potentially, you know, near term we've seen 61.8 respected. So maybe this is the end of it, but you know, it's also still a good chance we do continue to sort of drift lower. But I do see this pullback as exactly that, a retracement within an uptrend, and we need to see a breakdown through this 102.804 to indicate something other than that. But I think it's more likely that we see a breakthrough that support level through BOJ intervention than anything else. So keep an eye out on this one. For me, we're in a retracement phase set within a bullish trend that points towards an upwards move for this market. As we see Australian inflation coming out, we are, of course, very aware of the possible intervention at the BOJ. So keep keen on those stop losses. You know, be very aware of the risks involved from trading against the Japanese yen. But you know, despite the fact that they did manage to see that pullback coming into play, the trend is your friend, and the trend is pushing back against the BOJ, and it continues to point towards potential for upside as we go forward.